Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let's take a look at the stories for the day. At a time when several developed nations, including the United States, are staring at recession, India remains an island of stability. Backed by a strong rebound in consumption, India's economy is forecast to have checked double-digit GDP growth in the April-June quarter. But a closer look reveals that the good numbers are riding on the back of a weak base of last year when the nation was reeling under the pandemic. And the external sector is also facing serious challenges. So what are the likely implications of the forecast that have been released so far? Let us find out in today's segment.
The National Statistical Office is going to come out with the April-June quarter gross domestic product data on the 31st of August. But before the official numbers are made public, several projections have come out. The Finance Ministry estimates that the economy grew by around 15.6% in that quarter. This is lower than the Reserve Bank of India's Q1 FY23 projection. The RBI projects FY23 GDP growth at 7.2%, with Q1 forecast at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%. Most economists also believe that the economy grew at a slower pace than the RBI MPC's projection for the first quarter. Their projections range between 12.5% and 17.8%. Double-digit GDP growth in Q1 FY23 over the 20.1% growth clocked in Q1 FY22 may appear to be quite high, but that quarter was affected by the second COVID-19 wave. In fact, the economy shrank by 8.5% in Q1 FY22 when compared with the corresponding pre-COVID period of FY20.
If you compare what these estimates are really saying about where the economy is relative to 1920, then whether you're taking 16% or 13% makes very little difference. What you are saying is that the economy in the first quarter of the current fiscal year will be only a little bit. So the average growth rate from 1920 to now would be somewhere in the range of 0.8 to 1.2% over a 3-year period. Okay, so we continue to be virtually where we were in 1920.
Citing a senior official, the Business Standard report on Finance Ministry estimates said that GDP components like private final consumption expenditure, gross fixed capital formation, and government final consumption expenditure showed healthy improvement. But the trade component was likely affected by high commodity prices and rupee depreciation. While private sector capex has started crowding back in and private consumption has improved despite inflationary pressures, trade has been affected by geopolitical headwinds. On a related note, with exports growing at a much slower pace compared to imports, the country's trade deficit widened to a record $30 billion in July. In fact, merchandise exports fell to a 5-month low of $36.27 billion in the same month.
On the external front, I think we should not hold too much hopes, not for the next year, year and a half. But on the positive side, just about the time when the external side is going down, the domestic side is starting to pick up. Now, the real question is, which of these two contradictory movements moves faster? If the external economy tanks very quickly, then we may see a serious reduction in our growth rate. And that already seems to be happening. If the domestic economy recovers with greater strength than we are currently assuming, then that may be taken care of and we may still be okay.
Manufacturing, construction, mining, and agriculture, which are the sectors that make up gross value added, are also expected to show healthy growth. Even touch services like tourism, hospitality, and leisure have bounced back from the effects of the pandemic due to pent-up demand. In FY22, all sectors except trade, hotels, and communication services were above the pre-pandemic levels of FY20. During its latest rate action in early August, the Reserve Bank of India's Monetary Policy Committee retained the real GDP growth forecast of 7.2% for the current financial year. Given the changing external and internal picture, there might be a doubt about whether this forecast can be retained going forward. So, what factors will determine the final print for the current financial year?
Now, there would tend to be a downward trajectory for the growth rates across the quarters. And in this particular year, while we are looking at a number of 7.2%, we should remember that it may not be reflective of the buoyancy in the economy, which to my mind is still very much limited to certain sectors. We should remember that the next 3 quarters are going to hold a clue to this number of 7.2%. The reason why we say the next few quarters are important is that as we come into the festival season and harvest season, which is going to start from the month of October or maybe late September onwards, we need to see whether this consumption pattern is maintained or not. The pent-up demand has kept the economy ticking to a very large extent and has not really been bothered by inflation, which has gotten reflected in lower financial savings. On the whole, I think it's going to be a wait and watch as to how consumption plays out in the next few quarters.
We are back where we stood right before the pandemic hit. The negative effects of the pandemic will continue to play out for years to come, especially for the most vulnerable sections. While India remains one of the fastest growing major economies, it remains to be seen if and when it will hit the sort of economic trajectory required to both heal these scars and meet the considerable challenges that predate COVID.
The automobile sector's contribution is 49% of the manufacturing GDP. The demand for cars and long waiting periods also point towards economic revival. But there is a churn going on in the sector. As it tries to arrest environmental damage, the world is slowly but steadily turning its back on polluting machines. The transition to electronic vehicles or EVs is a big step towards this. But how will this transition affect the huge automobile component sector, which depends on traditional internal combustion engines? Let's find out.
Did you know that automobiles contribute over 24% of the world's direct CO2 emissions? Is it any wonder that electric vehicles are gaining traction across the world? India isn't far behind. According to the India Energy Storage Alliance, the EV market is projected to clock a compounded annual growth rate of 49% between 2021 and 2030. Niti Aayog has set a target of EV sales penetration at 70% for all commercial cars, 30% for private cars, 40% for buses, and 80% for 2- and 3-wheelers by 2030. Automobile manufacturers, including the component makers, have lined up 70,630 crore rupees for EVs over the next 5 years, according to a Business Standard report. The thriving auto component industry is bracing for a paradigm shift. It accounts for just over 2% of India's GDP. In FY22, it recorded its highest ever turnover of $56.5 billion, rising over 23%, while exports grew 43% to $19 billion. According to the Automobile Component Manufacturers Association, auto component exports are expected to touch $80 billion by 2026, and the industry aims to achieve $200 billion in revenue by 2026. The transition to EVs presents both opportunities and challenges for the industry. For example, there will be a major shift from traditional ICE components to e-drive modules and systems. Ratings agency CRISIL estimates that revenue of the electric vehicle components market in India is likely to rev up at a compound annual growth rate of 76% to 72,500 crore rupees by fiscal 2027. EV components present an opportunity for auto component makers to diversify their revenues. While 75% of revenue comes from parts that will remain in EVs too, the remaining 25% is at risk. At the same time, component makers who were traditionally reliant on engine parts for the bulk of the business and players in ICE powertrain business catering only to ICE engines and transmission could face a threat due to transition to EVs. Also, the number of components in EV powertrains is smaller, and this will affect the aftermarket business, leading to lower replacement revenue. The turnover of the aftermarket in FY22 stood at $10 billion. There will also be some impact on the millions of existing and upcoming personnel in the industry. For instance, EV part makers require more tech people than in the traditional ICE component making firms. So, the skills needed for emerging supply chains will be very different, and hence gradual upskilling of workers and understanding of the shift in nature of jobs will be critical.
The opportunities are much greater than the threats. Of course, because of the fact that this is a big change in terms of where we've seen the automotive industry, there seems to be a perceived threat. And most of the threats come from the fact that what technologies will OEMs adopt, what technologies, therefore, will the auto component industry adopt. However, the opportunities that exist are immense in terms of connectivity, in terms of autonomous, in terms of charging infrastructure as well. And as the capex cycle is kicked in, we're going to see a lot of supply from India out to outside of India. And therefore, investments in technology are key. So I think adopting new technologies is a challenge, definitely. Adopting the right technologies is also something that is new to us, because again, it's almost like we're reinventing the wheel or reinventing the cycle in terms of this from the supply side. So I feel that as it progresses, we will adopt technology much faster. So I think fast adoption of technology is a challenge.
The auto components industry, on its part, is looking to diversify beyond ICE vehicles. They still have the time to do so, and the companies have already begun investing in electric components for the existing ICE vehicle makers as well as for EV makers. ICRA estimates that about 25 to 30% of the total investments of auto component makers in FY23 and FY24 will be towards EV projects. Industry body ACMA recently said 60% of its 800 members are ready to supply components to EV makers, which is a good sign. For instance, Uno Minda has already begun developing specific products for EVs. Electric vehicles contributed 62% of the order book for another auto component maker, Sona BLW, in FY22. The industry also needs significant investments in research and development for building capabilities specific to EV powertrain components. This is one area where the industry is lagging, as the average R&D spend of the component makers is just 0.5% of their total spending. According to ACMA President Sanjay Kapoor, the same needs to go up to at least 3%. Experts say the auto component industry has more opportunities than threats in the shift towards EVs. The positive is that there is still enough time to de-risk and diversify portfolios. Going forward, an individual company's gains or losses will depend on product portfolio, customer mix, and the ability to re-engineer.
Reliance Industries is also hugely invested in green energy. According to reports, it is likely to soon double its investment in clean energy hardware manufacturing. Meanwhile, the company's share eked out modest gains on Tuesday, a day after its 45th annual general meeting. Analysts believe that though the investments across verticals will set the company on a decadal growth path, these may weigh on the stocks in the near term. Technical charts, however, suggest otherwise. Here's a report.
Investors remained unenthusiastic about Reliance Industries a day after the company's 45th annual general meeting. Though Chairman Mukesh Ambani spelled out detailed plans for telecom, retail, and new energy businesses, analysts cautioned against the high capital expenditures risks in the near term. Global brokerage UBS, for instance, highlighted that Reliance Industries' near-term debt will rise as it gets aggressive in its investments across verticals. Those at HSBC too said that recent transactions to purchase technology as well as investment plans for new energy should kickstart another engine of growth but will likely require investment in the interim. While e-commerce is gaining momentum, it is yet to achieve meaningful scale. Thus, the burden of revenue growth will fall on subscriber additions in the telecom vertical, and in the interim, the company will have to spend on 5G capex. All this, the brokerage said, will likely weigh on the stock performance in the near to medium term. Nonetheless, analysts suggest investors focus on Reliance Industries' long-term growth trajectory, with Akash Ambani taking over digital, Isha taking over retail, and Anant taking over new energy. Analysts said investors can be assured of a clear succession plan. Further, assigning timelines of 2024 and 2025 gives credence to the pace of work RIL has undertaken and the journey it still needs to take to bring down the cost curves of these new technologies. Given this, most brokerages also remain bullish on the stock from a 12-month perspective and see up to 19% upside. Technically too, the stock seems to be well placed to scale fresh lifetime highs.
Shares of Reliance Industry continue to remain bullish from a medium-term perspective. While the current formation is indicating a sideways trend, a sort of a consolidation, and any accumulation in the range of 2400 to 2200 would provide an added advantage. For the shares of Reliance to break out on the upside, the stock need to scale and overtake 2800 levels. The breakout would then instill a fresh rally that could reach to 3500 levels.
On Wednesday, markets will remain closed on account of Ganesh Chaturthi.
After markets, let us move on to a new provision in the income tax. This provision makes it compulsory for a person giving any benefit to another person for the business or profession to deduct 10% of the value of the benefit at source. This is Section 194R, which is recently introduced in the Income Tax Act, but it's also created confusion as a somewhat similar section already exists. Let's know more about it.
The government in the Finance Act 2022 introduced a new section 194R to the Income Tax Act 1961. It makes it mandatory for resident Indians to pay a 10% tax on benefits received by them. Section 194R makes it mandatory to deduct 10% tax at source on the value of any benefit or prerequisite received by a resident Indian. This section was introduced by the government to widen the tax base and reduce tax evasion in the country. Experts, however, have flagged several concerns. Are there any exceptions to the Act? The section will not apply if the value of benefit or prerequisite provided is less than 20,000 rupees. It is also not applicable to an individual or HUF with turnover less than 1 crore rupees for business or 50 lakh rupees for a professional in the immediately preceding year in which the benefit was provided. The threshold prescribed under Section 194R does not sync with the threshold prescribed under Section 56. Under Section 56, if the receipt of benefits by an individual or HUF exceeds 50,000 rupees in a year, they are liable to pay a tax on it. However, under Section 194R, the limit is 20,000 rupees. According to experts, this would lead to tax outflow, which is actually exempt in the hands of the recipient. The term benefit or prerequisite is not defined in the Act. The government had earlier stated that the receipt may be in cash or kind, but no clear definition was provided. This would lead to additional administrative challenges. It will also be difficult to calculate the exact valuation of benefits in kind, and it would also make compliances more difficult. The Act also brings samples received by doctors and traveling and other benefits received by influencers under its ambit. What can a taxpayer do if both sections 194R and 56 apply to the situation? Amrita Bhatnagar, Associate Director at RBSA Advisors, says that due to a lack of clear guidelines, they must pay the higher tax and claim the refund later through the income tax return. However, the government has not yet issued any clarification on these complications.
I will achieve, I will fly high, in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A clutch of banks has recently approached the Central Board of Direct Taxes, or CBDT, seeking clarity on Section 194R. The CBDT has assured that it would address their concerns. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.